You sent a note like, I don't know where if we're going to have recession, we don't know where earnings are going to come in. We don't know how long inflation will stay hot, but you do know that specific investment strategies over time prove to make money, and dividends are a big part of that.
Yeah, absolutely, Brian. I mean, the theme of 2022 was dividends, dividend growth, and it really saved our bacon and lots of investors over time. But what I found most interesting was a statistic I saw last week. I think Bob Pisani put it up, and it talked about the S&P 500 over almost the past 100 years, going back to 1926. And what it showed is that if you invest in the S&P, you get about a 10% return every year. And that's why we do it, Brian. If you can get a double-digit return, sometimes it might be up 30%, sometimes it might be down 30%. But on average, a 10% number is pretty good. It's pretty darn good. But look at that statistic, 39%, almost 40% of the total return comes from dividends and distributions reinvested. And I think that's what investors need to focus on 2023. Yeah, it's powerful.
Are you surprised by the strong start to the year, Kevin?
Well, I'm shocked because I don't think anything's changed here in 2023 from what we saw last year. I think the markets are completely ahead of their skis, and it's great, and I hope I'm wrong. But from a valuation perspective, what can make stocks go higher? Well, earnings could go up a lot, and that would be great, but I'm not convinced that's going to be the case. Multiples could expand, but when you have rising interest rates, typically the opposite happens. So from my perspective, from my lens, I think we're drinking some Kool-Aid here at the outset that maybe we should begin tempering our expectations a little.
I'm going to say something that probably just will throw a giant bucket of cold water on like the next 2 weeks of CNBC's coverage. So I apologize to all my beloved colleagues, but I wonder if earnings are going to matter that much. And the only reason I say that, and I know that's whatever, is because the market's run up is so big. After doing this 25 years, I can only get the feeling that people are buying ahead of what they probably view as less awful earnings and guidance. And if we get those numbers, which are going to be indeed maybe a little better than expected or less awful, I wonder again if the gains have been made, because we're making 6 and 7% moves in 2.5 to the first 3 weeks of the year, Kevin. I mean, that's an annual gain in many years.
I mean, it's great if you're a trader, right, Brian? But I tend to look over a longer lens, and I have to agree with you completely. You can set the earnings bar as low as you want, and it's not going to allow this market to continue on that trajectory. The good news is that, I think markets have they're paying some attention to earnings and economic data. Wage growth is down. CPI was really good. Service PMI came down. We've got core PCE this week. And to your point, earnings across the board. But from a valuation standpoint, I mean, you and I are just in sync on this. We've come too far, too fast. And if the market ends here at these levels at the end of 2023, I mean, to me, that's a win. So I would continue to be a little bit more defensive and absolutely take this rally with a little bit of a grain of salt and a fair amount of skepticism.
Yeah, listen, neither you nor I are technical analysis traders, though you probably look at it, 40-50, 4050, probably a pretty important point in the S&P. We're in this sort of declining wedge pattern. That's where we've often seen this resistance there. But let's be optimistic, right? It's 5, whatever it is in the morning on a Tuesday in freezing cold January in New York. Kevin, if we're able to bust through, would you say, okay, you know what? Good. Stocks are up. Maybe this year will be better than people think because, again, all due respect to our friends who come on the air, almost every strategist was spectacularly wrong last year. And now they're all kind of negative. They could be wrong again.
Yeah, it's the herd mentality that scares me. I don't like to be part of the crowd. But it seems like this week and last week, we've been hearing more optimism. A month ago, it was the first part of the year is going to be horrible. The second part of the year is going to be better. And now, since markets have reacted in a strong open out of the gate here, you hear more and more people talking about, well, maybe the beginning of the year is going to be really strong. I'm going to stick with conviction and mathematics and say that, markets trade on price. And I don't think that we're going to be able to extend this rally into the end of 2023. I just don't see it. And like you said, I hope I'm wrong. It'd be great if I was.
Some smart guy said something about short term, it's an adding machine. Long term, it's a weighing machine. Of course, I'm quoting Warren Buffett. Bottom line is this, wrap it up, Kevin. Longer term, 3, 5, 10, 20 years out, stay invested, look for cash flow, look for dividends, correct? I mean, that's it long term.
Dividends and distributions to shareholders. That's how you make money on Wall Street.